Inventory grew by almost 14,000 homes this week. That's a pretty solid number, but actually fewer than our model had predicted for the week. Available inventory of unsold homes continues to grow, but that growth in supply seems a bit less intense than it could be. The sales rate, though, the demand side, is slower than I've expected. It looks like we're heading back to those conditions in the second half of 2022, where inventory had grown rapidly, but any real downside correction, home price correction, was mitigated by a withdrawal of supply. Sellers can just wait it out. And it looks like in the U.S. housing market, those sellers are just waiting it out right now. And I think it's worth examining if sellers will indeed just wait it out now. It's been 2 years of waiting already. Glenn Kelman of Redfin this week, I think, was quoted saying homeowners can't wait much longer. He expects the second half of the year to see even more inventory growth. And I think that's a reasonable hypothesis, though the key here is that we don't yet see it in the data. And I'll share what I mean in the video today. That at Altos Research, we track all the home prices, all the supply and demand, all the home sales, all the changes in that data so that you can understand the changes in the U.S. housing market immediately as they happen. I'm Mike Simonsen. I'm the president of Altos Research, and let's take a look at the details of the U.S. real estate market as we approach the end of June 2024. So there are 634,000 single-family homes unsold on the market right now. That's an increase of 2.2% for the week, a growth of 14,000 unsold homes. That's a pretty big increase for a single week. It's the end of June, and the seasonal peaks for listing and pricing all happen now, so we probably have 1 or 2 more weeks of big inventory gains for the year, but the first week of July really includes the holiday, so the activity falls way off. In the inventory chart here, the big takeaway is that we'll have more inventory than 2020, so pre-pandemic, starting in July. If mortgage rates jump in late summer, we would see another boost in unsold inventory. Assuming no big spike in mortgage rates, then it looks like the available inventory of unsold single-family homes will top out in October at just under 700,000 homes on the market. We have a simple model for estimating how much inventory growth might happen in a given week based on the changes in the same weeks of the year in previous years. So, for example, the model expected inventory to grow by 16,000 units this week, and it grew by 13,000. So one way I like to use this forecast model is to observe that between January and April, inventory grew faster than the model predicted almost every week. But in 5 of the last 7 weeks, it's been the other way around. Inventory growth has been coming in below our expectations. So that's what happened again this week. 13,000 versus 16,000 predicted. So this tells us that inventory, while growing, is doing so at a relatively lighter pace than earlier in the year. That isn't indicative of runaway supply growth. You can see the continuation of that theme with the new listings volume each week. There were 72,000 new single-family listings unsold this week. That's basically unchanged from the previous week. It's 13% more sellers than last year at this time, but it is not expanding anymore this summer, really. The pace of sellers has plateaued for the year. And as I've been saying, for those expecting a continued, much bigger growth in inventory in the second half of the year, like Kelman, for example, where inventory growth helps supply and demand get out of whack. That's sort of a really bearish scenario. One thing required would be more sellers. You'd need to see week over week seller growth. We have more sellers than a year ago, but you'd also expect that to be continuing each week, that growth, and it's just not. You can really see that in this chart. The light red line is 2022. In late June of that year, inventory growth hadn't yet peaked. New sellers were still rushing to the market. Then after the 4th of July, they just stopped. So you can see how the 2022 line takes a big dip in the 4th of July. I highlighted that in green here, that moment in green here. You can see that 2022 dip in new seller volume. And so at that moment, that the sellers backed off July 4th of 2022 and they didn't come back. So suddenly the supply demand imbalance and market correction for 2023 had a cap, not enough sellers. So that pattern is kind of similar now, though not as extreme as 2022. This year, new listings growth seems to have peaked already back in May. That's a totally normal time of year. May peak for new sellers is quite common. What it tells us, therefore, is that this year, like 2022, we don't see signs of seller volume continuing to expand. So that dark red line here is illustrating the new listings volume this year, and it's kind of horizontal. So that's the supply side of the supply-demand equation. Supply isn't great. It's not really getting out of hand. On the demand side, however, demand is pretty weak. The data is pretty weak. There were only 67,000 new contracts started for single-family homes this week. That's 2.7% fewer than last week and 3.3% fewer than the same week a year ago. So in this chart of the new contracts pending, you can see the dark line from this year. It dipped below last year's pace for the first time in several months. This chart is of the new contracts started each week. These are single-family homes that have been listed for sale. They take offers and then they go into contract. And if we look at the total set of homes in contract, there are 396,000 of those right now. The sales take 30 to 45 days to close, so these will mostly close in July. That number, the number of those homes in contract is a couple percent more than last year at this time. So the pendings count peaked in early June, which is also totally normal. So the second half of the year has fewer and fewer home sales. So the takeaway from the pending sales data is that any growth in sales volume that we might have seen earlier in the year is gone. And this, of course, is a function of mortgage rates staying over 7%. There's just no incentive for buyers to jump in now. So unless and until mortgage rates drop, we're kind of in this holding pattern. The median price of all the homes for sale in the U.S. right now is $455,000. That's just a hair lower than last week, and it's unchanged from a year ago, 0%. So home prices, by this measure, are flat compared to last year. That's not surprising given the pace of sales I mentioned above, like there's no upward pressure on home prices. The median price of the homes newly in contract this week is $395,000. These are the homes that people are buying right now. That's down 1% for the week and is just 2.6% above last year at this time. So that's the chart we're looking at here. We're past the peak in prices for the year. If you look at the 396,000, all the homes in contract, the median price is still 4.4% greater than a year ago. So a price appreciation range is 0 to plus 4%. Depending on how you measure the market. The headlines, which use the lagging indicators of home sales that happened last month or 2 months ago, those headlines are still showing maybe 5 or even 6% home price appreciation over 2023 right now. And we expect those headlines to compress in the second half of the year into this 0 to 4% range. So continuing on the theme, slightly more inventory, weaker demand, you'd expect price reductions to be climbing. And in fact, price reductions are indeed climbing. There are more sellers each week that have to cut their asking prices. Nationally now, 36.9% of the active market has taken a price cut from the original list price. That's notably soft. When we look at the regional data here with price reductions, most of the year the Florida markets have been leading the way. Sarasota, Punta Gorda, all the Gulf Coast Florida markets. Supply is way up, demand is down in those areas. And so you have elements like property taxes and insurance costs that are also way up, and so that encourages more sellers. Now, as the year grows, the Western U.S. markets, the country markets, so those are starting to sneak back into the top markets with the most price reductions. Austin and Phoenix and Denver in particular is starting to climb back into the top markets of price reductions. So remember, 2 years ago, those pandemic boom markets, those Western U.S. boom markets, led the slowdown 2 years ago. So keep your eyes on those parts of the country right now. They had surprisingly strong 2023, but if we can use price reductions as a leading indicator, those markets may be slowing again. And that's why we do this data work each week. Home buyers and sellers are obviously sensitive to the cost of money. Mortgage rates have stayed higher for longer than anyone anticipated this year. They haven't come down yet. So what if they do? If you aren't watching this data each week, you're probably behind the curve. You have buyers and sellers who have no idea how this market is changing right now. They need to hear the data from you. You should join us at Altos. Go to altosresearch.com. Just book a free consult with our team. We'll help you know how to talk about the local market with your clients and prospects today. There's a link in the description below to join us. So click that and let's get started.